Hey guys, welcome to another episode of Fun Flip Repeat. I am your private money lender, Joel Cadlick, and of course with me, co-host, Mr. Cultivate Real Estate, Justin Foster. What's going on, man?
Not much, man. I got to tell you, that's sunny outside. It's been really freezing here in Tulsa, Oklahoma, and it's nice to have some good weather. I went and walked a property with our mutual friend, who's also a banker of a regional bank yesterday. And the wholesaler tells the tenants, there's a couple of duplexes that we were looking at, tells the tenants, my banker is here. So these are the bankers that are going to walk through. So it just happened to be, that was kind of like a story he was telling, which I don't love. You just say that we're partners or something like that because we're buyers actually. But we happen to be bankers because he's a banker of a commercial bank. And then I'm, anyway, with fixed lending. But our friend pointed out very quickly that I did not look like a banker at all. He looked like a banker and I look like some scrub that he picked up off the street. So
yeah, that's hilarious. He is your banker that you think of when you imagine a banker in your mind.
Yeah.
That's the beauty of being a private hard money lender is you just dress the way we're dressed right now. If you can see us, if you're watching the video.
Listen, call the guys in the flip flops because they're the ones that are poor and they're not the ones with the big buildings and the suits. So you can call us whenever you need a fund to deal.
Love it. Okay, so let's get into it. Today is going to be fun because we're going to talk about what happens if a deal that you're in goes lopsided, right? That's having some struggles. Maybe there's some red flags, and then some key things that you can do ahead of time proactively to avoid those mistakes, or if it's during the project, what you can do actively in real time. So that's what we're going to talk about today. Super excited about it. So I kind of wanted to start with just a story from something that I hear, well, not necessarily a story, but feedback that I sometimes get when I'm on these calls. So I'll have a borrower or investor reach out to me and they'll say, man, I'm really looking at this deal. I would love to get into it. Maybe this is my first or second deal. And when I'm looking at the numbers, it's really tight, but it's okay. I'm kind of projecting that I'm going to break even on it. But that's okay because I really want to learn. I want to get the education, and I know that comes at a cost. So, man, the thing that I would say to that, and we're just jumping right into it, right? The thing that I would say to that is what we know about real estate is it always costs a little bit more, and it always takes a little bit more time. So if you're planning on break even, you're actually planning to fail already because you're planning at losing money. And another important thing to remember is you need to have cash to stay in the game. Once you exhaust all your cash and you lose your money, you're not going to be able to stay in the game anymore. And staying in the game is super important. And that's something that I hear. And if that's something that you might be looking at or have said, I would challenge you to, guys, you're going to pay in your time. You don't need to pay in your money. And the most important thing is, like we said, to stay in the game, because you might do that first deal projecting that break even, and then it immediately takes you out of the deal and you never do another one. So avoid that.
100%. And, I think there's some sort of, you need to go, if you say that, like lock yourself in a closet with a journal and like figure out whatever kind of parent issues you grew up with. Cause it's like an upper limit dilemma. You're kind of saying, well, I don't really deserve to make a huge profit. Maybe you're agreeable and you don't want to tell the person selling the property, what you can actually pay that's going to be a healthy margin for you. So think about it as self-care. Think about this as, what is it that I need so that I can give other people what they need? And the reality is that you need room in the deal. You need a margin of safety, especially if you're early on in the game. Now, that being said, you don't want to go so far to the other side of it and just assume that you're always going to get a 25 or 30% discount on the property.
Right.
There's plenty of deals where a 20% discount is going to make a lot of sense if it's cookie cutter, if it's a lipstick job and you're not going to get hurt. And so what we're talking about
Depends on the project, right?
Is like risk. How do you manage risk? Part of being an investor is managing risk well. And like Joel said, the number one goal is to stay in the game, right? And to set yourself up like you're a fortress that's always going to stay in the game. that's going to allow you to build, to scale, to do more deals long term, and not get ahead of your skis, and ultimately give you everything that you want, whether that's time or more money or, you know, whatever your goals are.
Yeah, I mean, dude, one thing that we say is like, business is easy and people are difficult. And it's exactly that. We get in our own way. And yeah, Justin, she said, lock yourself in a closet. And that's so true. Listen, I've been there and I've had to lock myself in my own closet. And it kind of comes back to like confidence too. And it's hard to get that confidence if you haven't done it. And it is scary. So like, don't beat yourself up about it. You know what I mean? It's perfectly normal and natural. Like, you're a human being. That's the answer. But like, you've got to figure that out too. So yeah,
that's a story. We should tell that story. So when when Joel and I were starting out, we were meeting with our mentor, and we came, we were scaling up our wholesale business at the time, but you could apply this to anything. And so he asked us to come up with a number of what our revenue goal was. And we came up with a number that was, it was not, we thought it was a giant number. Like, oh, wouldn't it be amazing if we could make like $300,000 in revenue?
Yeah. Like a little nervous saying it too. Maybe I shouldn't even say this number.
$300,000 would be amazing.
Totally.
And we tell our mentor, he's like, what are you guys talking about? Go lock yourself in a closet and get a journal and sort out all your daddy issues. Then come back to me with a real number. It's kind of to hit you upside the head. And so there is,
but you know what? That's awesome, because it's like, you need, like, this is a great takeaway, right? You need someone, or you need to position yourself to be in the company of someone who's willing to kind of like hit you upside the head. And when that happens, don't shy away. Don't get super, what's the word I'm looking for? Offended. But think about that. Think about what they had said, and ask yourself, like, why did they say that? What is my, limits here? Like, why am I limiting myself? So yeah, it doesn't feel good to get punched in the gut, but it's so helpful. So you need someone who's going to punch you in the gut. Justin and I are partners, and I have no problem punching Justin in the gut, and he definitely doesn't have any problem punching me in the gut. So it's good for ab exercise, right?
So this brings up this point of like, don't fall in love with your own story. You have to kind of ground your story in reality. And some folks are seeing everything through rose-colored glasses, and they think that they're going to make $100,000 on every single flip. But then some people do the opposite, which is they get in their own way and they shoot themselves in the foot with undercutting themselves. And both are detrimental. Right. Many entrepreneurs and flippers are maybe optimistic by nature, but you kind of have to know yourself here. You have to know where you're going to fall on this. And then what you really want is somebody looking over your shoulder, helping check your blind spots, wherever they may be, to ground you in reality.
Right. And, let's keep on the topic of risk too. So what we see the most of when it comes to rose-colored glasses, or we also like to call it euphoric optimism, right? As entrepreneurs, we're wired to be euphorically optimistic, and we're excited, and we're going to do this thing, and we're going to do it big, and we're going to do $1 billion next year. I'm making, silly examples, but it's true. Right. And one thing, bringing it back to risk when we're talking about deals being lopsided, is comps. Okay. Mm-hmm. I would say 95% of the comps that we might look at are a little bit inflated. And you have to look at it. The market is always changing, right? The market has gone through a lot of changes just more here recently. Interest rates going up, prices coming back down a little bit. So comps is one thing that you really need to look at, but also have an extra set of eyes. Maybe that's a trusted realtor, or maybe that's a trusted private hard money lender, such as fixed lending, but when they say, hey, I think you're off on your comps and this is why, just take a minute to actually look at that and analyze it. It's okay to question it, and maybe you have different ideas, right? You don't have to take that feedback for exactly what it is, but definitely use that as a way to protect yourself, because you want to be super realistic. Because if you're going into it and you're $10,000 off on your comps, or it's going to take longer to sell because you want to list at over and above, then that's just going to eat into your bottom line and eat into your profit. So comps is a big one. It sounds simple, but it's super important.
And you want somebody on the other side of that may even tilt towards being the Eeyore. You know who Eeyore is? Like the donkey that's like always, Debbie Downer on everything. Yeah. Just be able to listen to, if you tend to be optimistic all the time, somebody who tends to be a little bit like, I want to poke holes in this. You want to know that. And
Yeah,
you
like
know,
on
every
promise and over deliver for yourself. That's
100%.
a great
So
thing.
every good deal has been vetted through somebody who is like the opposite of you, right? And that it starts there with analysis. And so you want to see, okay, what are the comps? Be conservative about the comps. And then you want to stress test some of the other numbers that you might have. What about if it's going to be a rental and you're going to keep it, don't just assume you're going to get $1.25 per square foot and it's going to be perfect and 100 people are going to want to rent that. Stress test the price per square foot on the rental. Stress test
Yeah.
your vacancy rate, right? Don't just assume that it's going to be 5% vacancy. What if it was 10% vacancy? What if it was 15% vacancy? Where's your break even on that? And you can stress test other items in the deal as well. We're not going to get into deal analysis, but you want to think about sort of best case scenario, kind of medium case scenario, and then worst case scenario, and either one of those. And then you want to be able to accept any of those outcomes. And this plays into like another way that a deal is good, and you know it's good, is somebody's already stress tested. You stress test it yourself, and you're playing with these numbers on a worst case basis. And then you can accept that. And the reason that you might be able to accept the worst case basis is because you have multiple exits. So where people get in trouble on a deal
Yep.
is that they don't have multiple exits thought through at the beginning. So if it's a flip, it's like, that's okay because I can just put it into my rental portfolio for the next couple of years, let the market do its thing, and then I'll sell it. You're in a really strong position. Whereas if your time horizon is, nope, I got to get in and out in 3 to 6 months, I got to make this money and I got to sell it or else I'm screwed. That's your only exit. It's like, that's not a very great exit especially when your time horizon is shorter. So if you have an exit where your time horizon can be longer, that allows the market to do its thing and it minimizes your risk exposure. These are the makings of good deals whenever you go through the analysis. Multiple exits, stress testing the numbers, and then there's backstops that you would have, right? Backstops, the number one backstop that you're going to have to do, good deals is to have cash. Joel said it right. I mean, cash is ultimately the thing that keeps you in the game. And guys, this isn't just about one deal. It's about compounding and growing, scaling. And so you got to think about time in the game is what's going to build your wealth. So don't feel like you have to, a lot of people, Joel, I feel like have this idea that debt is a religion and they just have to have every single dollar deployed and they have to have maximum leverage on everything that they have. Those are the people that get taken out of the game 100% of the time, right? Well, not 100% of the time, but whenever there's blood in the streets, those are the guys that are going to fall.
There's a stark difference. And it's like bringing it back to what we're talking about too in a deal, if it's going lopsided, like what's going to help you? What is going to help you sleep at night a little bit better and alleviate that stress is having cash flow reserves while you're in that deal. So if you're going into a deal and it's like, hey, you need to bring $20,000 cash to close, and that's every single dollar that you have, let's go back to the what if scenario. What if it takes a little bit longer? What if you have to, extend it? What if, a million different things.
The scope of work is off and it actually costs 20% more. Like how often does that happen? Every time.
Well, that's a good thing. So like, here's an action item, right? We always like to provide some action items on the podcast. Is like today, what would be a really helpful exercise if you haven't done it is like, pen and paper, Word document, ChatGPT, Excel spreadsheet, whatever. Go in there and list your what ifs. What if I go over budget? What if I didn't comp it quite right? What if, the project goes longer? What if I have to hold this property and turn it into a rental and hold it for the next 5 years? These are the worst case scenario type things we're talking about. And if you can answer, that's fine. I'm good with that. With that. I can live with that. I'm healthy enough in my cash to be able to take that on. Then like you guys are really setting yourself up for success to minimize the risk as much as humanly possible. Okay. So yeah, that's a big one. Just ask yourselves those what ifs.
I love it.
But also, right, you hit on something that's super important too, is like, what if your scope of work is off? Okay. What we said in the beginning is it always takes a little longer and it always costs a little more. So what a very easy practical thing you can do is put in a contingency. Maybe that's 5% of the overall budget is a contingency line item for unforeseeables, right? And now you have that cushion in there. Depending on what your rehab and, your draws and stuff are going to be. Well, now that you have that in there, it's always a good practice to have a contingency line item. And it's not there to just withhold, draw funds. It's there to protect you so you can tap into that. And there's, less issues when you're in the project. So it's like preparing for all of these things ahead of time is really going to help you in the back end.
I love it. So once you kind of are the Eeyore, you find your Eeyore in the deal and you're saying, what if, and going through all the kind of worst case scenarios of this, it's also okay to then say, well, what if it goes right? So don't forget that. You have to have a balanced view, a very, ideally a stoic view of this. And then you kind of want to fall in between those two things. Imagine, don't short circuit yourself and imagine. I see a lot of folks, who never get into the game.
Such a good point.
Because they never ever imagine that it's going to go right.
Yeah.
And so you want to underwrite the deal with a lot of stress, but then in order to take the risk and act on it, you still have to have an optimistic scenario that you're trying to achieve, right? And nothing's going to go perfectly, and don't expect that, but things can go really, really right whenever you take some risk in real estate. So if you have multiple exits, you have cash reserves, you have other people who are Eeyore who are being like, I would buy this deal, right? And all of that checks out, right? Of like, oh, I would buy it at that price. I would do that deal. That looks like a great deal. Great deals, good deals, they jump off the page and there's consensus that that's a good deal. You don't have to talk to too many people to figure it out. Then don't be scared to pull the trigger. Don't be scared to move on it.
Right. Yeah, because we know about the analysis paralysis, and you don't want to be crippled by it, because you truly could become crippled by that. And if you're it really truly does come down to a really healthy balance. And then you just have to commit and say, hey, yes, I'm going to do this. There's no single deal that's 100% risk-free, because it's the world we live in. Anything could happen, right? It could be like World War III. You just can't predict everything. So you have to assess, hey, what's my comfortability level? What's my risk tolerance? And feel comfortable in this. You don't know everything. You're going to make mistakes. You're going to get dirty with it, but that's okay, because that is part of the learning process. It's not, hey, I'm just going to go into this at a break even because I want to learn. It's like, hey, I'm doing all of the due diligence I possibly can. I'm approaching this strategically. So set yourself up for success. But yeah, that's true, man. You got to find that balance, and you got to be able to go for it, and you got to be able to make mistakes. Mistakes are okay. If you learn from them and apply them, that will be your strongest weapons and your great advantage, honestly.
Yeah, you're just playing probabilities. And early on, you have a learning curve, so you need more margin of safety for sure to have the probability that you're going to have success. But the margin of safety also could just be just a low leverage into the deal. Maybe you bring an extra, 20, 30, 40% down, and you have extra cash, or a partner if you don't have the cash. Joel, that's what you did on your first deal. You partnered with somebody. The way I did my first deal was I was able to put more money into the deal, more skin in the game. And so because I had low leverage,
yeah, we talked. You're
in a better situation either way. If you partner with somebody, you have low leverage that way. You're just learning from somebody else's experience. Or if you have the resources to be able to put down a big down payment, then you're probably going to be okay if it's even just a base hit boring deal. So.
Right. Yeah, no, we talked, so last week we did an episode with Ben. If you guys haven't heard that, you definitely hop over and take a listen to it. Lots of gold nuggets. And we're hitting on some similar things as far as follow someone's lead, have strategic partnerships, have good relationships, and, it's okay to get messy too. We talked about all that, and he has got such a good story. So that's what kind of reminded me of that right now, Justin. But so many of these things just ebb and flow and apply to it. So one thing I wanted to talk about that sounds like, oh gosh, that's so common sense, simple, basic, elementary stuff, but it's so easily overlooked. And these are the things that are important, right? Going back to business is easy, people are difficult, we get in our own way, is if a deal is truly going lopsided, you've done all the due diligence, you ask yourselves what ifs, that's okay. And if you're in a deal that's going lopsided, the best thing you can do is pick up the phone and call your private hard money lender and let them know what's going on. Okay, don't hide or shy away from it. I'm talking specifically, how we would do it as far as fixed lending goes, because we truly view it as like a partnership. So call us. We can maybe get creative. We can help identify what the problem is. But like, as long as there's good communication, that solves so many problems. If there's zero communication and all of a sudden, like, boom, there's this massive issue, then there is going to be massive issues, right? So communication, or reach out to somebody that is in, a local meetup group or something. Say, hey, I'm dealing with this. Do you have any experience? How could I get out of it? You might be able to, fire sale the property or wholesale it, or, someone can find a creative solution for you to still turn what you think is a bad deal into a good deal. So like it's natural for us, right, as humans, especially if we haven't done a lot of deals and we're not super confident, to kind of like feel, I don't know, Justin, like maybe ashamed or like nervous or like maybe I'm no good, like these negative thoughts. But like, people want to see you succeed and they want to help you. So if you call and say, hey, I need help, or hey, this is the situation, I think you'd be surprised like what the response would be. And that really is talking about mitigating risk too. It's just those appropriate communication channels.
Yeah, 100%. I mean, if you do enough real estate deals, no matter how good you are as an investor, and you're using some leverage, some form of leverage, you're going to have to pivot. You absolutely will have to pivot at some point if you do
Right.
enough deals.
It's not if, it's when, right?
Joel and I have had to pivot out of deals. And the goal is to never lose money always, right? And so have that mindset. Don't be flippant about, in some situations like this, I know some guys that are very seasoned investors even, and they'll just like throw around the idea that they've lost money like it's like nothing. Like that's really something. If you do find yourself in a deal where you're going to have to take a little bit of a bath on it, be okay with that. You're not alone. Many investors have been there. Joel and I have lost money on one deal. There might be a couple of deals where we've lost money actually, but learn from that. Don't just flippantly say, well, you win some, you lose some, and sort of have a policy like that's okay. And then if you are in that situation where you feel like you might have to take a bath on a deal, yeah, get ahead of it, communicate early, figure out all your options right out the gate so that you can try to preserve your capital. Yeah. It's a big deal to lose money because that's after-tax dollars that you've lost and you're going backwards, not forward. So don't throw around this idea of like, well, yeah, I might just lose some money on deal, but that's like kind of the price of admission or something like that. Like, no. That's not investing. That's gambling. You can't be a gambler in this game. That's Warren Buffett's rule. The first rule of investing is never lose money. And the second rule is never forget rule number one. It's 100% true. But I like what you're saying, Joel, about communicating early on and especially tapping on the shoulder of people who might be more resourceful than you, either in terms of their network, in terms of their ability to, strategically think through the deal, or tapping on somebody's shoulder who may have liquidity, right? They might have the cash. They might be somebody who's opportunistic about a situation like that. And, just getting out from underneath the deal and kind of giving up on the equity might be the best thing to do early, because when a deal starts to go bad, it can get really bad really fast if it's going that direction. So you'd rather pivot sooner rather than later for sure.
Yeah. I mean, one thing I love to say is some of the best deals you do are the ones you don't do, right? You might be avoiding a massive mistake. So some of those best deals are the deals you don't do because you might have lost $30,000. And you're like, man, if I didn't do that deal, how awesome would that be? Sometimes it requires some patience and exercise with that. But yeah, that's it, man. 100%. I think another thing that I would want to say is it really stresses the importance of having people local. And this is funny too. I'm going to refer back to a podcast that we did with Ben again. He does it virtually, right? He's a million miles away, but like the folks and the team that he's built up is
They're
here
all local.
in town.
Yeah.
They're local. And that helps you too, because it's like, man, they know the streets, they know the people that they could connect you to. Hey, I know that this deal might be going lopsided, but John Smith would partner on this with you and pick this up for you. Or so those are super important things. Same with, private money. You're not a cog in a wheel in some like metric online. It's someone you could actually pick up the phone and talk to. It's no different than like traditional banking when you have your big banks like Chase. What kind of relationship are you going to have with like a Chase bank? No shade on Chase, but like your local banks where you actually have a relationship you can go to lunch with, you can have coffee with. So important. So, man, yeah, I think we hit on a lot of stuff as far as like lopsided deals, protecting your downside, exit strategies, comps, communication. I'm going to say it a couple times. And any final things before we hop off?
No, and just be honest. That's the biggest thing on the
Honest
communication, right? And so if it's not a problem, you don't have to feature it, right? If you can figure out what the solution to the problem before you communicate it is like, hey, I ran into this issue. This contractor stole $5,000 from me, but I already have somebody else, and that's great. That's fine. But if the guy stole 50 grand from you, and he ran off to Mexico, you got a real problem. And hey, this is what happened. I don't know what to do. Then the private money lender or whoever you're working with is going to say, thanks for coming and bringing this to me. Let's put our heads together and see what our options are. I'm going to help you get out of the situation. If you go into hiding,
absolutely,
or you lie about that, that's where things just go really sideways really fast. So, just tell the truth.
Yep. Love it. Okay, guys, thanks for joining us again. Remember, every fourth Tuesday of the month, we have a live in-person meetup group. We will post that in the show notes. I hope you guys are enjoying the show, and we'll talk to you next time.
Peace.